Did you know that trillions of dollars change hands every day in the foreign exchange market? It's the biggest financial market in the world. Forex, or foreign exchange, is simply the trading of different currencies. Think of it like exchanging money when you travel to a different country. Forex trading aims to profit from the constant fluctuations in exchange rates. Everything happens in pairs called currency pairs, the heart and soul of Forex trading. Currency pairs are the building blocks of Forex trading. Every currency pair consists of two currencies, the base currency and the quote currency. The base currency is the star of the pair, always listed first. The quote currency comes second and tells you how much of that currency you need to buy 1 unit of the base currency. For example, in the EUR-USD pair, the euro, EUR, is the base currency, and the US dollar, USD, is the quote currency. If the EUR-USD is trading at 1.10, it means you need 1.10 US dollars to buy 1 euro. When the value of the base currency goes up against the quote currency, the pair's price increases, and you make a profit if you're buying the pair. Conversely, if the base currency weakens, the pair's price goes down and you might face a loss. Now that you understand the basics of currency pairs, let's explore the different types you'll encounter in the Forex market. Currency pairs are broadly categorized into 3 groups: majors, minors, and exotics. The majors are the most traded pairs in the world, involving influential currencies like the US dollar, USD, the euro, EUR, and the Japanese yen, JPY. Examples of major pairs include EUR-USD, USD-JPY, and GBP-USD. These pairs are generally more liquid due to their high trading volume. Next come the minor currency pairs, also known as cross-currency pairs. These pairs don't include the US dollar and typically involve one major currency paired with another, like EUR-GBP and GBP-JPY. Finally, we have the exotic currency pairs, involving one major currency paired with the currency of a developing or emerging economy, like the Mexican peso, MXN, or the Turkish lira, TRY. Examples include USD-MXN and EUR-TRY. Exotics are generally less liquid and can be more volatile due to their dependence on the economic and political conditions of emerging markets. Section 4. Navigating bids, asks, and spreads. When you look at a currency pair quote, you'll see 2 prices, the bid price and the ask price. The bid price is the price at which buyers are willing to buy the base currency. The ask price is the price at which sellers are willing to sell the base currency. The ask price is always slightly higher than the bid price. The difference between the bid and ask price is called the spread. The spread is essentially the cost of trading a currency pair. Brokers make their money through the spread, so it's an important factor to consider when trading. Another key concept to understand is pips, representing the smallest price move that a currency pair can make. Understanding these basic concepts of bids, asks, spreads, and pips is essential for interpreting currency pair quotes and making informed trading decisions. Section 5. Understanding orders and leverage. In Forex, you trade currency pairs by placing orders through a brokerage account. The most common orders are market orders and limit orders. A market order is an order to buy or sell a currency pair at the current market price. A limit order is an order to buy or sell a currency pair at a specific price or better. Another crucial concept in Forex trading is leverage. Leverage allows you to control a larger trading position with a smaller amount of capital. While leverage can amplify your profits, it can also magnify your losses. Therefore, it's crucial to use leverage responsibly and understand the risks involved. Section 6. Mastering the art of trading and risk management. There are 2 main approaches to analyzing the Forex market: fundamental analysis and technical analysis. Fundamental analysis focuses on economic, social, and political factors that can influence currency values. This includes things like interest rates, inflation, and economic growth. Technical analysis involves studying historical price charts and using technical indicators to identify patterns and trends. Regardless of your approach, risk management is crucial in Forex trading. One of the most important risk management tools is the stop-loss order, which automatically closes your trade at a predetermined price level. Another important aspect of risk management is proper position sizing. A good rule of thumb is to risk only a small percentage of your trading capital on any given trade. Section 7. Recap and encouragement. Congratulations. You've now completed a crash course in currency pairs and Forex trading. We've covered a lot of ground, from understanding currency pairs to exploring trading strategies and risk management techniques. Remember, Forex trading involves significant risk, and it's essential to do your research. Start small and never stop learning. Now it's your turn. Share your thoughts and questions in the comments section below, and let's keep the conversation going.